You walk into a dealership, mention your ABN, and the salesperson's face lights up. Suddenly, they're talking GST credits, instant asset write-offs, and depreciating the full purchase price. It sounds like the car practically pays for itself. And if you're running a trade business or a small company, you've probably already been Googling whether this actually works the way they say it does, because something about it feels too good to be true. Well, you're right to be suspicious. We worked with an electrician last year, operating through a company, a solid income, bought a $75,000 SUV under the business name. He claimed the GST credit and started depreciating the vehicle and felt like he'd made a smart move. Then his accountant ran the end of year numbers and hit him with a $15,000 fringe benefits tax bill. A tax nobody at the dealership mentioned. A tax that made the car more expensive through the business than if he had just bought it personally. If you're sitting on a similar decision right now, ABN in hand, dealer quote on the table, not quite sure whether the tax savings are real or a trap, this video gives you the answer. You'll know exactly when a business vehicle purchase actually saves you money, when it costs you more, and the one question to answer before you sign anything. Before I get into where this goes wrong, I need to explain why the pitch sounds so good in the first place, because the appeal is real. If someone told you buying through the business is a smart tax move, they weren't lying to you. They just left out a few things. When you buy a car through your business, 3 things happen on paper. You claim back the GST on the purchase price, you deduct the depreciation of the vehicle against your business income, and depending on how the car is used, you can also deduct running costs like fuel, insurance, and servicing. If the car costs $69,674 or less, which is the ATO's car cost limit for 2025, you can claim the full amount. Go above that number, and your deduction is capped, regardless of what you actually paid. A lot of people don't hear about that cap until after they've signed. Now, on the surface, that combination of GST credit plus depreciation plus running costs looks like a genuine advantage. And for some business owners, it is. So the deductions are real, the GST credit is real, but they come with conditions that most people only discover after the finance contract is done. And the biggest condition has a name. If you're operating through a company or a trust and you use that vehicle for anything personal, even once a week, there is a second tax sitting underneath the one you think you saved. It's called Fringe Benefits Tax, and it can wipe out every dollar you thought you were ahead. FBT applies when a business provides a benefit to an employee or director that isn't part of their salary. A company car that gets driven to the shops on Saturday, that's a fringe benefit. Dropping the kids at school, fringe benefit. Any personal use at all triggers it. The rate is 47%. That's the top marginal tax rate. Doesn't matter what your personal rate is. If FBT applies, it's calculated at 47% on the taxable value of the benefit. You can reduce that taxable value by keeping a logbook that proves what percentage of the car's use is genuinely for work. If 80% of your kilometers are business related, you're only paying FBT on the remaining 20%. But if you don't keep a logbook, or the one you started 6 years ago has lapsed, the ATO applies the statutory formula and you lose control of the calculation entirely. The way to reduce FBT is the operating cost method, but it only works if you've kept a valid logbook. The rules are specific: a continuous 12-week period of records capturing every trip, business or private. Once you've done that, the logbook is valid for 5 years. If 80% of your usage is business, you're only paying FBT on 20% of the running costs of the vehicle, which can drop a $15,000 FBT bill down to a couple of $1,000s. No logbook or a logbook that's expired, you're stuck with the statutory formula. 20% of the car's base value every year, no matter how much business use you could have proved. And something worth knowing about that dealership conversation, they push ABN purchases because they may earn better commissions from business lenders, or it may be easier to approve. The person selling you the car has an incentive to put it under your business name. That doesn't mean it's the right move for your tax position. So if you're buying a personal use vehicle through a company or a trust, FBT is not optional, and it is not small. For a $70,000 car with even moderate personal use, you could be looking at $10,000 to $20,000 a year in FBT. That's not a tax saving. That's a new line item on your tax bill that didn't exist before you drove the car off the lot. Now, one of the areas where this gets messier is when business owners don't set up the right structure before they start pulling money out of the company. Even if FBT doesn't apply to you, even if you're a sole trader, that whole section felt irrelevant. There's a second problem that catches almost everyone. It comes down to one document that most people fill out once and never think about again. The ATO requires a logbook to substantiate any car expense claimed using the logbook method. It has to cover a continuous 12-week period. Every trip recorded at the time, not reconstructed from memory in May, date, start and finish odometer readings, kilometers traveled, whether the trip was business or personal, all of it. Without a valid logbook, the ATO can deny the claim outright or force you onto the cents per kilometer method, which caps your deduction at 5,000 business kilometers, regardless of how much you actually drove. For someone doing 30,000 business kilometers a year, that's a massive difference. We had a client buy a Lamborghini under the business, $500,000 plus, slapped the company logo on the side, called it a marketing tool, thought he was being clever. The ATO doesn't recognize marketing tool as a category. The car cost limit still capped his depreciation at $70,000. FBT still applied because he was driving it personally. And when he sold it for $500,000, the GC clawback alone was $45,000. By the time you add the balancing adjustment and the years of FBT, the tax bill on that fully deductible marketing tool was over $100,000. Branding doesn't change the law. So keep the logbook, keep it current, and understand that the ATO's cost limit means expensive cars are often cheaper to buy personally. The deduction has a ceiling. The tax bill doesn't. Now, everything I've covered so far applies to passenger vehicles, sedans, SUVs, and hatchbacks, for example. But there is a category of vehicle where the rules work completely differently. And for a lot of tradies watching this, this is the part that actually matters. Commercial vehicles, utes, vans, trucks, designed to carry a load of 1 ton or more. They are exempt from FBT, provided private use is kept to a minimal. That means no fringe benefits tax, no logbook requirement on the FBT side. And in many cases, full deductibility. The car cost limit that caps passenger vehicle depreciation at $70,000 doesn't apply. This is why every second tradie on the road is in a Hilux or a Ranger. It's not just personal preference. The tax treatment is genuinely different. If the vehicle is classified as commercial and you're using it on the tools, the business purchase makes sense. The GC credit lands, the depreciation lands, and FBT doesn't apply. But commercial vehicle has a specific condition. It's about the manufacturer's specs, specifically the payload capacity, which is GVM minus the curb weight of the vehicle. If that number is below 1,000 kilograms, you're not in the commercial vehicle category, regardless of what the badge says. And here's the trap nobody mentions. Plenty of modern dual cab utes sit just under that 1 ton threshold. Once you add a canopy, drawers, and a bull bar, check the compliance plate before you sign. The other thing to know, even on a genuine commercial vehicle, the FBT exemption only applies if private use is minor, infrequent, and irregular. The ATO's guidance says, short diversions on the way home from work are fine. No more than 1,000 kilometers of total private use a year. No single private trip over 200 kilometers. School runs every day, family road trips, you're outside the exemption and you're back in FBT territory. If you're buying a genuine work vehicle that meets the commercial classifications and you keep the private use within the safe harbor, buying through the business is one of the cleanest deductions available. If you're buying a sedan or an SUV for mixed use, the math changes completely. And you need to run the numbers before you commit. If you take one thing from this video, make it this. Before you walk into a dealership, before you talk to your accountant, before you start comparing models or finance options, there is one question that determines everything else. When a client tells me they want to buy a car through the business, the first thing I ask is, what car are you looking at? Not what's your budget, not what structure you're operating through, what car, because the vehicle itself determines the tax rules that apply. A Hilux and a BMW are taxed in completely different ways, even if they cost the same amount. Even if they're bought through the same company, the car dictates the structure, not the other way around. If it's a commercial vehicle, the path is straightforward. If it's a passenger car, you need to factor in FBT. The cost limit, the logbook, and whether the after-tax costs still make sense compared to buying it in your own name. So pick the car first, then talk to your accountant, not the dealership, your accountant. And if they can't explain the FBT implications, the cost limit, and the logbook requirements in plain language before you sign anything, get a second opinion. We work with business owners on exactly this kind of decision every week. If you're sitting on a car purchase right now, and you're not sure whether the numbers actually work in your favor, or you just want someone to run through your structure and tell you where you stand, that's what we do. Links in the description. See you in the next video.